Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello and welcome to Business Line's State of the Economy podcast series. This is the 9th of the podcast focusing exclusively on the markets, and this series is coming to you regularly every month. Bringing you insights from the market experts is your host, Parvatha Vardhini. I am the editor of bl.portfolio, Business Line's Sunday feature on investments and personal finance. The expert speaker for this month is Mr. Vishal Jain, CEO of Zerodha Fund House. Vishal was part of the founding team of Benchmark AMC, which launched India's first ETF in 2001, the Nifty Bees. He joined Goldman Sachs AMC in 2011 as CIO passive after the acquisition of Benchmark AMC. He was the head ETF at Nippon AMC too and has over 20 years of experience building ETFs and passive products. Welcome, Vishal, to the podcast.
Hi, Vardhini. Thanks so much for inviting me. Pleasure to be on your show.
Thank you, sir. And it's nice to have you too, because this time the topic is very different. I think you are the right person to talk to us on passive investing. I was looking at your profile and it says over 20 years being in ETFs and passives. And the very first passive fund that came up in India you were possibly part of it, isn't it, sir?
Yeah, that's right. So I was part of this company called Benchmark Mutual Fund, which was launched way back in December 2001 or so. And we launched a whole host of ETFs, which today are the most popular ETFs in the market, right? From products like Nifty Bees, Junior Bees, Bank Bees, Gold Bees, Liquid Bees. These were products that we launched, way back in 2001, 2002 at that point of time.
Yeah, great, sir. So a lot has happened on passive investing since the pandemic, especially, isn't it? If you see AMFI monthly numbers and all that, passive as a percentage of total investments coming in or total AUMs, whatever be the metric, I think there has been a rise. And, I thought I will right away start with the hot topic, which has been in the discussions the last 1 or 2 months. Now, small and mid cap, a lot of passive launches have happened. At the same time, on the active side, SEBI has also been, putting funds to stress test because they think there is a bubble in this space. So, you think that these fund sizes are also getting larger at the active end, and people, here says that they are finding it tough to deploy the money in this space. So that way, sir, do you think, passive could be the way forward or the solution, especially for the small and mid-cap space?
Okay. I think, SEBI's concern is more towards, excessive flows in a segment that, in a sense, is considered as riskier, and therefore the ripple effect there may be if there is a sharp fall or if there are any huge redemptions that come in a particular scheme. Now, whether it's active or passive, both, whether you're an active fund or a passive fund, both will be accessing the same market. So if there's ever a freeze, in that segment due to any sharp fall in the markets, I mean, both would get affected in that sense. It's just that at this point of time, I think the AUMs in active schemes are much larger. The only other benefit that I see, say, in a passive scheme is that it's not restricted towards, say, maybe 80 or 100 stocks. Generally, most passive small cap schemes, would track the small cap 250 index, and therefore there are a larger number of companies that you would be tracking. But nonetheless, I think it's important for investors, to build a portfolio such that they take their, risk profile into account in their financial needs. It's important to have a healthy asset allocation mix, whether it's equity, debt, and gold. And it's always better to have a combination, even within equity, have a combination of active and passive schemes, both in your portfolio.
Okay. So staying with the passive and small and mid cap, I also understand that there are a lot of micro cap passive launches also, which have happened in the last 1-2 years, because for the simple reason that the markets have been doing well and, a lot of opportunities presented themselves. Now, do you think, passive is looked upon by investors only at a time when market does well? Because, after a point, an active fund, for example, in a small cap space, when when the market does well, say gives you 25% for a 1-year return, a passive fund, even if it gives you 25 or 24 or 20 or even 27, investors like the high returns that are coming in because of the market conditions. On the other hand, when the market falls or when there is volatility, does an active manager who is probably able to contain the losses better than the index in these segments tend to score well?
No, I don't think it's so much to do with an active or passive kind of a fund. I mean, I think the bigger issue is how do you pick a scheme? I mean, today there are 30 mid-cap schemes, there are approximately 30 large-cap schemes. I think the issue is how do you pick a winner from all of those? Even if you look at the latest SPIVA report, Standard & Poor's comes out with in India. So SPIVA basically stands for S&P Index versus Active report. And this report has been coming now for at least a decade and a half in India, and it compares the performance of active schemes versus passive schemes. If you see the latest report which has come out, it shows that over a 5-year period, around 58% of the schemes have underperformed their benchmarks. And over a 1-year period, it's nearly about 73% or so. So the issue is that even if 73% have underperformed, you've got 27% that have outperformed their benchmarks, right? But how do you pick these 27%? Right? There have been different funds beating their benchmarks or beating the index at different points of time. And therefore, I think the issue is that how do you choose a scheme? And therefore, it makes more sense to have a good active passive kind of mix in your portfolio, whenever you're investing here.
Okay. So you are telling us that, irrespective, see, a passive fund in a small cap space or a mid cap space may not be the top performer, but it may not be the bottom performer also, because there are many active funds which may fare worse than the passive fund actually.
Right. So the schemes that are outperforming keep changing all the time. So then the big issue is how do you pick the right scheme? I mean, if somebody would tell me that, okay, Vishal, put your money in this XYZ scheme and it's going to outperform in the next 3 years, then fine. But how do you pick that scheme?
Okay, sir.
I mean, how do you pick the next winner? Yeah, is the point.
Yeah, sir, got your point. So staying with the passive funds, apart from the SEBI stress test, the other news point these days is that the window for overseas investments, especially the ETFs, got shut, very 1 or 2 weeks ago. So now a lot of talk went on about international diversification, how you should diversify your portfolio if you have dollar spendings in future. A lot of talk was doing the rounds in the last 2-3 years. Now, investors seem to be left with very few options if they want to actually diversify overseas because of this problem. So how do you recommend taking exposure to international markets now? Is investing in US listed ETFs, for example, possible for Indian investors?
Yeah, well, I think, as you mentioned, I think it's fantastic that, investors are able to, invest in international products over the years. And there is, so if at this point of time, they're not able to invest in, the Indian international funds, the only other way for them to invest is through the LRS route, through which you can invest 250,000 USD every year. Now, how should one pick a scheme over there? I think it's better to, as you mentioned, pick ETFs. Possibly, I mean, I would recommend that investors should look at the broad-based indices, preferably the S&P 500 or the NASDAQ 100 kind of an index, and maybe go for an index fund or an ETF in that sense. So preferably look for the larger schemes and invest in a broad-based diversified schemes, rather than picking up some kind of theme or some kind of sector.
Okay, sir. And see, at Zerodha itself, you have both passive offerings, both on the equity and in the debt side. So I think your first fund was the large and mid-cap fund, the offering that you started out with. Now, the SPIVA report, or, if you follow markets closely, we all know that a lot of people prefer large cap passives because large cap active funds tend to be bigger underperformers. Or we just spoke of why mid and small cap space, it makes sense to have passive at some point. Now, what is the argument for large and mid cap? How did you choose, this segment, to have your first fund in?
The ZFH, Zerodha Fund House's objective is to help more investors access financial products. And in our case, mutual fund products. We want to equip them with products that are simple, transparent and affordable, because we believe that that's the only way that will lead to greater financial inclusion. And we believe that passive products kind of exhibit these characteristics because they're transparent, they're low cost, they're easy to understand. Our first product, as you mentioned, was based on the Nifty Large Mid Cap 250 Index, and it's a kind of a 50-50 split between large cap and mid cap. So the 50% goes into large caps, the top 100 large caps which are there, and 50% of the fund goes into the 150 mid cap funds that are there. It's a diversified index, across about 20 sectors. We felt it's a good combination where large caps kind of bring the stability and mid caps give the growth kicker that you'll get from the mid caps. So while considering which index to launch on, we chose this large cap mid cap 250 because we wanted to launch one product where investors could keep investing in perpetuity and take exposure to the long-term India growth story. And this combination, as I said, was a good combination between stability and growth.
Okay, sir. And so moving on to debt. Now, these target maturity funds as debt passives were very, very popular until the taxation change for debt mutual funds. Now, do you think debt passives still make sense, be it the target maturity category or the other categories? And which categories and why do they make sense?
Sure. I mean, see, investment should not always be looked at in terms of taxation, right? Target maturity products, fulfill a certain need as they have a fixed maturity, and one can use this product based on your specific horizon or investment needs. It is akin to a fixed deposit, but in my opinion, it has a much lower risk because the portfolios are diversified, they're transparent, and therefore don't carry that single issuer risk, right? Whereas when you compare it to, say, fixed deposits, where one is taking exposure to a single entity, one must consider the fact that if anything ever happens to the bank, what is guaranteed is only 5 lakh rupees. But when you look at any debt product, whether it's passive or active, they're much safer in my opinion because they're transparent and they come out with a daily net asset value. And therefore, the value of that fund on a day-to-day basis. A passive product, I mean, because of its features, is that much more transparent and low cost, and therefore investors can decide depending on their needs whether they'd like a target maturity fund or whether they like other schemes which are constant maturity. I think it just depends on your financial need and your objective.
Okay, sir, but the argument against, target maturity funds come up because in today's, higher interest rate scenario, there are, with the same taxation as a fixed deposit, be it a bank fixed deposit or a corporate fixed deposit, the YTMs you see on a broad range of target maturity funds that are available seem to be slightly lower than bank deposits or even your very highly rated corporate deposits. So the taxation was the only sweetener, I mean, the favorable taxation. So, which is why a lot of focus is there on the taxation, actually. So as a category, the inflows have completely come down, isn't it? So,
right. But Vardhini, see, one must always look at the fact that any, additional return also comes with that risk, right? And therefore, when you're talking about, say, investing in corporate deposits, then you're taking exposure to that one entity, which is not the case, say, in any mutual fund product, whether it may be target maturity or whether it may be constant maturity or whether it may be a regular debt fund, which is there. So one must always kind of weigh the pros and cons, versus investing, say, in a fixed deposit or a corporate deposits versus investing in a portfolio that is far more diversified.
Okay, got your point, sir. Now, in terms of other categories, for example, in Zerodha itself, you have this liquid one-day rate ETF, and then there are, not so many, but you do have a 5-year GSEC ETF in the market. So, in terms of other categories in debt, so what do you think are good categories for passive, and do you expect those categories to become more popular?
So at this point of time, I think barring, say, target maturity funds, I think there are very few passive, debt products that are there in the market. I think as we, progress, I think from our perspective, we would definitely like to launch a couple of, passive debt products because we believe that, again, our focus is on simplicity, and we believe that, until we come up with simple products in the market, you will not find investors taking on to those products. So it's a segment that we want to work on. Retail investors taking on to passive debt products has been a bit slow, but it's something that we would, as a fund house, want to work on. And you'll hopefully see a couple of products coming, from our stable in the next couple of quarters or so.
Okay. So these inclusion of Indian bonds in Bloomberg or JP Morgan's emerging market indices. Now, I did mention that we do see one or two passive products based on G6 currently. So do you think this could be a trigger to have, more passive products in India on bonds?
I mean, again, I think, it's overall very positive for the country, as one would expect more flows coming into the country. It's good for the debt markets because it'll improve overall liquidity and debt. Inclusion of our Indian bonds in the JPM index is actually more relevant for international investors, and in that sense not so much for Indian investors, because in foreign investors usually kind of follow some kind of benchmark, whether it's JP Morgan or it's MSCI or it's Standard & Poor's or so on. So it's very different markets that we're talking of.
No, my question was more about, because of more fund flows and, the markets deepen and, one fund houses may be more confident about introducing ETF products on, these bonds.
No, so definitely if the liquidity and the depth of the markets increase, then it'll be a very good thing for passive products. So, I mean, obviously you will then going ahead see more and more passive products, especially linked to government securities coming into the market as we go ahead.
Mm-hmm. Okay, sir. Now, this is a very pertinent question for all investors. See, for example, I avoid ETFs and I go for index funds because of this simple reason. So, although they have very low expense ratios compared to even index funds, now there are issues, 2-3 levels of divergences. Now, there is one divergence at one level between the market price of the ETF and the NAV. And then at another level, there is a difference between the market price, the NAV, and what the benchmark of the fund, whatever return that is showing. And then when you go for gold ETFs, then another layer gets added where there is a gold price which you can always keep relating to, and then there is a price and for the ETF per se. So, what are the key factors that lead to such differences? Doesn't it leave investors very confused? Now, how do you choose products when there are so many divergences?
See, I think, Vardhini, things have gotten better, over the years. I mean, when I look at ETF liquidity, I see is becoming much better day after day, day after day, year after year. So when I've been in the ETF market now for nearly 2 decades or so. I know the challenges that we were facing, say in the early 2000s as compared to the challenges that you're facing now. Simple things. I mean, people are taking on to ETFs. Look at the number of investors who have now invested in ETFs. If I remember correctly, March 2020, this is during COVID time, there were only about 18 or 19 lakh investors who had invested in ETFs. Today it's 1.2 crores, right? So there's been a sharp spurt of nearly 6 to 7 times in number of investors adopting ETFs. Also, what has happened over the last year or two, SEBI has introduced a number of positive regulations on the passive side, where they've made it mandatory for fund houses to display the indicative NAV on their websites. So investors, and the second thing is also to appoint market makers for each and every ETF that is there. And therefore, if you see over the last year and a half as well, liquidity has kind of increased in most of the ETFs, across the board. Investors can look at these indicative NAVs, which are available on their websites, on the individual fund house websites, and a lot of them are also available on exchange websites, and then accordingly buy and sell based on what they see, as the indicative NAV that is there. Investors should look at those ETFs, especially you will find that the broad-based ones will be far more liquid than the sectoral ones or the thematic ones. And therefore, you'll find that liquidity kind of tending more and getting better in the large cap and the broad-based ones, when you start looking at the data. I think both products, whether it's an ETF or an index fund, I think they both make sense for an investor's portfolio. If you are, if you're somebody who's constantly trading in the markets or have a demat account and a broking account, I think an ETF is a good product for you to look at. If you don't have a broking and demat account, I think an index fund is a good product for you to look at. The biggest benefit of any ETF or an index fund or a passive product is that you're able to build a good asset allocation. So today, if I was to build, an asset allocation across equity, debt, and gold, I could buy 3 ETFs and build a good asset allocation for myself, or for that matter, I could even take exposure to various index funds and fund of funds in gold and debt products and create an asset allocation. So the importance, I think we should not miss out. Whether it's ETF or index funds, it's important that through a passive product, you should build a good asset allocation mix, which helps you, achieve your financial needs and also keep your risk profile in mind.
Okay. Two questions from this. Number one, you did touch upon measures taken by SEBI. One is the indicative NAV and the other was the market making getting better. So for the benefit of the investors, what do you think are the 3 or the 5 measures that it may be work in progress or it may already be implemented, but what would you call the game changing measures for the passive investor in India?
So I think the game changing has been over the last 5 years. I think a lot of work has been done on the passive side, and therefore you'll see, over the last 4 5 years, AUMs becoming what they are. I mean, today ETFs are about 7 lakh crores of AUM. Index funds are about 2 lakh crores of AUM. Number of investors in index funds have also shot up by 10 times. Number of investors in ETFs have also shot up 6 or 7 times. I think a lot of what the industry wanted over the last 4 to 5 years, I think SEBI has done. And therefore, you're already seeing that change. I'm very hopeful and positive that this will just keep getting better as we move ahead.
Okay. Could you possibly mention the measures, sir? Is that possible?
So 2 measures which SEBI took somewhere in 2017, 2018, one of the measures was that all schemes, right, at that point of time were always benchmarking themselves versus a price index. So there are 2 types of indices that are there in the market. One is a price index and one is a total returns index. Now, a price index doesn't take into account dividends that are issued by the scheme, whereas the total returns index does. Now, most schemes, right, used to benchmark themselves versus the price index, and therefore the difference between the price and the total returns index is what you call as a dividend yield. The dividend yield varies between 1 to 1.5% depending on which segment of the market you're in. And this gap of 1.5% was being shown as outperformance by a lot of these active schemes since, 2 decades or so, right? But which was never outperformance. They were dividends that were earned by the underlying scheme, which was due to the investors anyway, right? The second change that SEBI made in 2018 was the scheme categorization, where they brought in categorization of schemes. So if you were a large cap scheme, these were the 100 companies that you could invest in. If you were a mid cap scheme, companies from 101 to 250 is what you could invest in. If you were a small cap scheme, 251 to 500 is what you could invest in, and anything above that was micro cap, right? So that scheme categorization came. Otherwise, what was happening in earlier instances that a lot of times you would call yourself as a large cap blue chip, but still have about 35-40% of your portfolio in small cap or mid cap companies. And therefore, if markets went up and you showed that as a kind of alpha or outperformance, but it was never alpha or outperformance, it was all risk in that sense, or the fact that you were taking exposure to smaller companies. So I think these were 2 big changes that SEBI made, and therefore when data started coming out in 2019 and 2020 is when people started looking at the performance. I think that's when a lot of change happened, because people started questioning that, look, what's the point of paying such a high expense ratio if there is no guarantee of outperformance, right? And I think that was a big game changer that led to increased flows in index funds and ETFs.
And the other question and the last question based on, the answer you gave me before, is it possible to build an entire portfolio based on passive funds and ETF? Choices have increased over the last 4-5 years. And is it possible and is it also advisable for an investor to build an entire for short-term, medium-term and long-term goals out of only passive funds?
Vardhini, I'm a prime example of that. I have only 4 or 5 ETFs in my portfolio, and that's what I've done for the last 15, 20 years. I don't think my portfolio is done too badly. I generally pick up a large cap ETF, a mid cap ETF. I always kind of also like to invest in gold because I think that gold, is an asset class where the correlation towards equity is very low. And therefore, if there is any uncertainty in the market, gold is something that kind of cushions your portfolio. I think these are 3 products which I always use to build my portfolio. And that's what I've always used for the last, I think, decade or decade and a half. So I think, yes, it's possible. for someone to build a good portfolio, I think it's important to keep, having that asset allocation mix, because then you get benefits of, all the asset classes that are there. Nobody can sit here and predict which asset class is going to do well. Gold shot up 15% in the last month or so. I mean, nobody could have predicted that, right? So it's better to have a good asset allocation mix so that you are able to get the benefits of each of the assets that are there in your portfolio. And the best way to do it is through ETFs and index funds.
Okay, sir. Great. On that note, thank you very much, sir. Thank you for the conversation. I'm sure it will be very useful to our listeners.
So thank you so much, Vardhini.
Thank you, sir. See you.